All right, we have a question here. The, the draft income statements for this company for the year ended 31st December 2016 as follows. So here we've got an income statement and a balance sheet for this company for the years 2015 and 2016. Yes. All right. So I'll be going through the items as I'm solving the question. Right. Let me just read the remaining information. Says the following information is available. Plant with a net book value of 260,000 was disposed of on 1st December 2016 for 184,000. A rights issue at 95 Ngwe per share was made during the year ended 31st December 2016. So, we're required to prepare a cash flow statement for the year ended 31st December 2016 in a form suitable for publication. So, colleagues, with a cash flow statement, as I said, there are two ways you can do a cash flow statement. There's the direct method and the indirect method. All right. So I'm going to today what we'll be looking at is the indirect method. So the cash flow statement is just showing how cash is moving in and out of the business. All right. And it's divided into three subgroups: operating activities, financing activities, and investing activities. All right. So the first thing that we need to do when we're using the indirect method is we need to calculate our operating profit, which is also called the profit before interest and taxes. Okay, that's the first thing you need to calculate, your operating profit. Okay, so in questions, they're not going to explicitly give you the operating profit. So one thing you should remember, your operating profit is just your sales minus the cost of goods sold and any other operational expense. Okay, the only expenses you shouldn't include when calculating operating profit are interest and tax. Remember this. Okay, when you're tabulating your operating profit, you're deducting all operational costs or expenses from the sales. The only expenses you're going to exclude are interest and tax. Okay, so if we come to our financial statement here, we're looking at the year 2016. Okay, so we look for our sales figure here. Sales for that year, 19,080 kwacha. Right. Then we look for operational expenses. All right. So I said all expenses you can include them except interest and tax. Okay. So here the operational expenses we have are the overheads and depreciation. Okay. The tax, even these dividends, do not include these dividends when calculating operating profit. Do not deduct them out. Okay. Yes. So we're going to say 19,080 minus 15,134 minus 384. We get, let's see here, we get this value here, 3,562. Okay. When we deduct sales from overheads and depreciation, we get our operating profit of 3,562. Any questions before I move further? Because we're going to move slow at a slow pace until everyone gets this. Okay. So first thing you need to get is your operating profit. Okay. And I forgot to mention this. We're dealing with the first section of the cash flow statement, operating activities. Operating activities, these are the day-to-day activities that your business goes through. Okay. For running your business basically. Okay. So the first item you start with is operating activities, where you start with your operating profit, which is your profit before interest and taxes. Yes. Any questions before we go to the next part? Or just follow. Okay. The I've put this is the format. Yes, this is the way I'm answering is the standard format. But I'll give you a document which has the standard format. But just pay attention to the way I'm doing it here. This is also the standard format. Then I'll send a document which shows you every item that is put into this. Is that okay, sir? Okay. I will send you that standard format. But also just pay attention to how I'm doing it. This is also the format you need to do it in. Okay. After you get your operating profit, the next thing you need to do is you need to adjust for non-cash expenses. Okay? Make adjustments for non-cash expenses. These are expenses which are included in the income statement, but no cash was transferred. Okay? Examples of these are depreciation, amortization, impairment loss, bad debts written off, and any provisions. Okay. There are some expenses which you'll see in the income statement where cash hasn't been paid out, but those expenses have reduced your profit. So you need to add them back. Okay. Because no cash was exchanged. Okay. So the first non-cash expense we need to add is depreciation. Okay, depreciation, loss in the value of an asset. The more you use an asset due to wear and tear, its value reduces. Okay, the value reduces due to wear and tear. So here, since in the income statement depreciation was deducted when tabulating your profit, so you need to add it back. Okay, so you add 384 positive. Okay. Any questions before I move to the next non-cash expense? Uh-huh. Or you're talking about under the operational activities, the elements that must be found in there. Okay, say it depreciation, amortization, impairments, bad debts, and provisions. So I'm going to send you a document uh, which shows the standard format of the cash flow statement and everything that you find in a cash flow statement. Okay, sir? Yes. So for now, uh, just remember those that I've mentioned, those are non-cash expenses, so they need to be added back. The other non-cash expense is also the loss on disposal of an asset. Okay, when you sell an asset for less than its value, okay, we call that a loss on a disposal. Okay, so that loss on disposal is also deducted from your profit. It's a non-cash expense because this loss that you've incurred, you haven't paid it out. Okay, but it's subtracted from profit in the income statement, so you need to add it back. Okay, so how you calculate if you've got either a gain or a loss? Okay, because if it's a gain, it will be treated differently. You need to subtract. If it's a loss, you will need to add. Okay, so this is how you find out if you made either a gain or a loss in the disposal of an asset. Okay, first thing, this is the formula here. Okay, it has to be cash minus net book value of the asset. Cash minus the net book value. Remember this formula, okay, colleagues? Cash minus net book value of the asset. Okay. Net book value, the way you get the net book value is you have to subtract the value of the asset when it was bought minus any accumulated depreciation. Okay, that's how you get your net book value. The value of the asset when you bought it minus any accumulated depreciation, that will give you a net book value. Now, in this question here, they told us this, right? This plant had a net book value of 260,000. So, after we deduct accumulated depreciation, this is the value of the asset, 260,000. Now, this asset was sold for 184,000. Have you seen? The asset is worth 260,000 after you account for accumulated depreciation, but it sold for 184,000. Okay, so to see if whether you've got a gain or a loss, you say cash minus the net book value. So you say 184 minus 260, you get negative 76. So since it's a negative value, so it means you made a loss on this disposal. Okay, colleagues? A negative value means you've made a loss. A positive value, it means you've made a gain. Okay, I repeat. After you've done cash minus the net book value, if you get a negative one, there was a loss. When selling this asset, you sold it at a lower price, so there was a loss on disposal. You get a positive item, a positive value. It means when you sold the asset, there was a gain on the disposal. Now, if you have a loss on disposal, it's usually deducted in the income statement. So since this is a non-cash expense and it is deducted in the income statement, you need to add it back here. That's why I've put it as positive here. Okay, because it reduced our profit, but it's a non-cash expense. But it reduced our profit. So that's why we need to add it back. If it was a gain is added to our profit and it's a non-cash gain. So it means you would have to subtract here. Any questions? Madam Agnes, any questions? Madam Naomi, any question? Mr. Emmanuel, Mr. Ronald, Mr. Sandy, Madam Yande. Sorry, I can't hear you. I can get you. Yes, we're going through that same question. Now, I need to find out, have we understood on the disposal of an asset? If there is a loss on the disposal, since that loss is subtracted in the income statement, we have to add it back because no money was paid out. If there was a gain, that gain is added in the income statement. And since no money is taken when we have a gain, so we need to subtract it. Okay, colleagues? Yes. And they always like to bring this. So this one will rarely miss. There will always be disposal of an asset. Okay? There's always going to be disposal of an asset. So when you see the disposal of an asset, if you've been given the net book value and you'll be given how much was paid for it, just subtract cash minus net book value. Okay? Yes. So we add 3,562 plus 384 plus 76. You get 4,022. Okay? 4,022. The next adjustment was to under operating activities is the changes in working capital. Okay, colleagues, working capital, this is just the money used for the day-to-day operations of a business. So that's why under operating activities, this is money that is used for the day-to-day operations. So working capital involves current assets and current liabilities. And I remember when I started tutoring you, we looked through what are current assets and what are current liabilities, right, colleagues? Because in a cash flow statement question, you'll be given a balance sheet and you need to know where my current assets are and where my current liabilities. So I hope you know all the current assets and all the current liabilities. Madam Agnes, are you okay with all the current assets and liabilities? Mr. Ronald, are you okay with all the current assets and liabilities? Madam Yande, okay? Mr. Sandy, Madam Naomi, and by current asset, this has to be used up within a year. Current liability has to be paid within a year. All right. So here, changes in working capital. Okay. So now remember these principles. Okay. I wouldn't advise you to memorize. It's just to understand what is going on. Okay. So we start with our current assets. Okay. Our current assets here, we've got inventory and receivables. Do not do bank or cash. Only the other current assets. Okay, because the cash, you're going to see the cash balance is the what's going to be dealt with at the end. Okay, so we start with inventory. Okay, we look in 2015, our inventory was 984 kwacha. Okay. Then in 2016, it grows to 2,256. So what this is telling us, we have an increase in inventory. Okay. So now I'll ask you, colleagues, if there is an increase in inventory, is money going out or money coming in? Let's say you, we can't hear you, Madam Yande. Hmm. Okay, colleagues, were you able to get that? I've heard. That's yeah, that's correct, Madam Yand. That's correct. Colleagues, have we heard? Mr. Emmanuel, you wanted to also say something? Hmm. Okay. Yes. So if your inventory increases, yes. If your okay, Mr. Emmanuel, maybe just say it. Madam Yande wasn't audible to others, so just say you are more audible. Yes. 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 So yeah, when our inventory increases, it means we've bought more inventory. Okay, we've paid out money to get more inventory. All right. So what you can remember is if there's an increase in an asset, just know it's like money is going out to get it. Okay, money is going out to get it. So just hold on. Let me just attend to. Yeah, money is you're paying out money. Okay. So it's an outflow. So just remember, if there's an increase in an asset, think of it as an outflow. Okay. If there's a decrease in an asset, think of it as an inflow. So you will find out by how much has the inventory increased. Okay. So you're going to say 2256 minus 984. 225 minus. Sorry, colleagues, I'm just dealing with some people on WhatsApp, so that's why I'm pausing a bit. Okay. Yes. So you do 2256 minus 984, it's 1,272. So we're deducting because we're saying this is an outflow. Okay. Taking this as an outflow. That's why I've put it as a minus. Okay, colleagues? Yes. Then we look at trade receivables. In 2015, 4,852 in 2015, then 7,036 in 2016. So we can also see an increase here. Okay, increase in our receivables. So just remember, any increase in an asset, take it as an outflow. So you say 7,368 minus 4,582, you get 2,786. So you also represent it as negative since it's an increase. Any questions? Any questions, queries? Increase in assets, outflow. Decrease in assets, inflow. If you ever forget that law, just think about with inventory. If my inventory is increasing, means I'm paying out money to buy more inventory, so cash outflow. Okay. Yes. Any questions before we now move to the current liabilities? It's money owed to us. Uh-huh. Did someone raise their hand? Mr. Sunday? Okay, we go to now the current liabilities. So here, payables. All right. Payables. Tax. Yes. Yeah. Okay. You are very audible, sir. Yes. You have a question, sir? Mr. Sunday, you are audible. I can hear you. Are you still there? Mr. Sunday? Okay. When you are able to talk and you get network, you can still ask. Yes. So here, the current. Uh huh. Okay. Who's raising their hand? Who has raised their hand? Okay. Yes. So as I said, we're going now to the current liabilities. So we start with payables. In 2015, 1,580. In 2016, it is increased to 2,730. So colleagues, this increase in payables, is it an outflow or an inflow? Hey, Madam Agnes, if you are a business and you delay to pay your suppliers, it means that money you're going to use it for something else, right? Madam Naomi, do you agree with that? If a business delays to pay its suppliers, it means that money which was meant for the suppliers, they're going to use it, right? So will we regard that as an inflow, as an outflow? Mhm. If the money that was meant for suppliers, you don't pay your suppliers and you use it, is that an inflow or an outflow? It's an inflow, yes, that's correct. That's an inflow. So any increase in liabilities, current liabilities, inflow, because it means you are using that money for something else. Then any decrease in liabilities, it means you've paid for that. So it's an outflow. You have paid the incongruous. Okay, so first we start with payables. There was an increase from 1,580 to 2,730. So you subtract 2,730 minus 1,580, you get 1,150. The other liability we have here is this ACT on proposed dividends. Okay. This is also money that has to be paid. Okay. So we can see in 2015 it was 130. These dividends had to be paid. Now it's grown to 205. So another increase in our liability, current liability. So you say 205 minus 130, you get 75. Now, colleagues, notice that I haven't used overdraft here. You know why I haven't used overdraft? Because this overdraft here is in relation with this bank balance here. Where is the bank balance here? Bank balance. Okay, it means the bank balance was on the credit side. Okay, if you remember from our T accounts, bank or cash is an asset account, so the balances are always on debit side. Okay, but if the balance is on the credit side, it means you are owing or there's an overdraft. Okay, so that overdraft there of 804 is from the bank balance. It's telling us we've got a negative bank balance there. Okay, and you're going to see when we do the cash statement reconciliation, I'm going to show you how we're going to apply that when we do the reconciliation. Okay, yes. Then these other liabilities of tax and dividends, you're going to see them. These will be used for us to tabulate how much tax and the dividends were paid. Okay, so these ones, corporation tax and proposed dividends here, you are going to see how they'll be dealt with. Okay, so these changes in working capital, you add. You say negative 1272. minus 2786 plus 75 plus 1150, get negative 2833. Okay, once you add these four, you get negative 2833. Okay, then you're done with your changes in working capital. Remember, we're still under operational activities. Okay, we're still under operational activities. We started with the non-cash expenses. Now we've looked at working capital. The next, we're going to now find out how much tax has been paid or how much interest. If there was interest in the question, we would have found out how much interest was going to be paid. Yes, madam. Tax can be a liability. Even in this question here, there's a tax liability here. Okay, but what we're trying to tabulate now is how much tax was paid. Okay, but in this question, to answer your question, madam, tax can be a liability. Okay, because sometimes you might not pay it just there and then. Okay, so this is how much you find. This is how you find how much tax has been paid. You can use this formula. Okay, opening tax liability plus the tax expense, which is on the statement of profit and loss, minus the closing tax liability. Okay, just remember, opening plus the expense minus closing. Okay, even for if there was any interest, okay, and you want to find interest paid, you would use the same formula also. Okay, so we come to our data and we see what's our opening tax liability. This one here, 1930. Okay, it's the opening tax liability for 2016. And the closing one is 3,557. Okay, so the opening is on 2015, closing 2016. Okay, so you get these two figures and you come to our statement of profit or loss. How much was corporation tax? 1,852. Okay, 1,852. Okay, now it doesn't mean that this whole 1,852 has been paid, all of it. Okay, I forgot to mention in the income statement, colleagues, those figures you are seeing, majority of them, or not majority, but a good number of items in the income statement, it doesn't mean in actuality that was the amount that has been paid, or in actuality that's all the profit you have. No, even sales doesn't mean that all that money is from cash sales. Sales can also be, some can be from credit sales. Okay, so this tax expense which we're seeing on our income statement, we shouldn't think that it has just been paid. No, all of it has been paid. No, because there's also a tax liability in our balance sheet which is telling us that some hasn't been paid. Okay, so using our formula here, opening tax liability 1,930 plus the tax expense 1,852 minus the closing tax liability 3,557. The that has been paid this year 225. Okay, and you present it as a negative value because it's money going out. Any questions? So if there was any interest also, and we saw interest was also on the balance sheet, you would do the same thing here. Okay. Okay, once we've got that, then we can find our net cash from operating of activities, meaning we add this 4,022 plus negative 2,833 plus negative 225, and we get 964 as cash from operating activities. Any questions? Any questions, queries? All right, we go to our next section, which is now investing activities. This way here we're just talking about purchasing non-current assets. Okay, and the mostly purchasing of non-current assets. And if the company receives any dividends or any interest, you put it here because if the company is receiving interest, it's obviously invested in some corporate bonds. Okay. If the company is receiving any dividends, it's invested in some shares somewhere else. Okay. But remember, investing activities here, you're just dealing with the purchase and sale of non current assets. That's what you must remember. When you reach the investing activities part, think about the non current assets, the ones sold, the ones that have been bought. All right. So, first thing, we need to find out how much has been paid for our plant, property, and equipment. Okay. Why am I saying this? Because if you go on the balance sheet here, okay, as you can see, plant, the figures increased 2,914 to 4,176. Okay. Now, before you subtract to say that, okay, we bought plant for this much, okay, there will be some certain factors you need to look for first. And this is the formula also you need to use to calculate how much has been spent on buying non-current assets, PPE. Okay. The closing balance of the the specific non-current asset minus, then you put in open brackets, the opening balance, any depreciation, subtract any depreciation, and you add any revaluation, and you subtract the net book value on disposal. Okay, I hope you remember this formula. If you can't remember this formula, then you have to use the knowledge of the T accounts, which I'll show you in another video. If you can't remember this formulae, then you need to remember how the T accounts work. Okay. So this is how you find out how much has been paid for any non-current assets. Okay, especially plant, equipment. So closing balance, we saw it was 4,176. Here we're focusing just here on plant, colleagues. Okay, only on plant. This formula applies to any plant, property, or equipment. Okay, so closing balance 4,176, opening balance 2,194. The, then also we've been told plant has a plant of 260 has been disposed, so we need this amount also. Okay, because if you just subtract this and you ignore this, you'll get wrong figures. We have depreciation also given to us, 384 there. There's no revaluation surplus here. So we put in our formula now here. Closing balance 4,176. minus open brackets, the opening balance 2009-14 minus depreciation 384 minus the net book value on dispose. That's the plant that was disposed was 260. That was the net book value. Okay. So when you subtract, when you do all these tabulations, you get 1,906. So this has been how much has been spent to buy plant this year, 1,906. So since we are buying plant, so we are representing it as a negative number. Any questions? Okay. Then we can look at now the other non-current assets. These are the ones which you can simply subtract now. It's only on plant, colleagues, all right? This applies to plant or any equipment or any motor vehicles, okay? This. The other intangible assets, you just easily subtract, okay? Patents, you can see, in 2015, we never had any patents. In 2016, we have patents worth 3.8. So it means we purchased these patents. Okay, we purchased the patents. So here, since it was a purchase of patents, 380 here, negative value. Okay. Then for land and buildings, as you can see, land and buildings, 2015, 1,600, 2016, 2,000. So obviously land or a building has been bought. So you subtract 2,000. Actually, these are in millions. Actually, these are in millions, yeah. So 2 million minus 1,600,000. 400. Okay. Representing with a negative because we bought. Then remember, we also sold this plant in this question here. Remember this plant that was sold for 184,000. This 184,000 is a cash inflow. So that's why we're adding it here. 184. All right. So you add now negative 1,906 minus 380. Oh, plus, you're adding all of these. Remember, the cash flow statement, you're adding, okay, it's plus. So this plus this plus this plus this, you get negative 2,502.